This is Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're taking a close look at one of the subsectors that could be affected by the issues in the bank sector. We're talking about mortgage-backed securities with Erica Adelberg, CFA. She is a senior mortgage-backed securities strategist at Bloomberg Intelligence. Previously, she held similar roles at Seaport Global, KBC Bank, New York Life, and GSAM. She got her BA in math at Chicago. So thank you for being here, Erica.
Thank you for inviting me, Rob.
So the first thing that we have to talk about, because it is one of the biggest indicators in the MBS sector, is spreads, and you know more about it than most people on the planet. So what do recent spreads directions tell you about how MBS is doing?
Mortgage spreads are about as wide as they've been in more than 10 years. In fact, really, you'd have to go back to a period of the financial crisis of 2008 to really find sustained spreads this wide. In this, we're really talking about current coupon spreads, but that's really relevant to the mortgage sector overall because that's where new issue is getting produced. And therefore, that tumbles down the whole chain to where the rates mortgage borrowers can get loans. So as a result, it's pretty important. But it's also a key indicator of where new issue is able to be absorbed and therefore the amount of stress in the market right now. Now, most of the mortgage market, very unusually, was issued 2 years prior when rates were at record lows. So as a result, on those lower coupon securities, mortgage spreads aren't quite as wide. But overall, the option-adjusted spread, if you will, of the whole index is still, at stressed levels.
Right. That was one of the key differences in your comparison between now and the great financial crisis. Are there others that are different now that are behind this widening of the spreads?
I'd say one of the biggest differences is now most of the mortgage-backed securities market is agency mortgage-backed securities. There used to be a very large non-agency mortgage-backed securities market that was not guaranteed by Fannie Mae and Freddie Mac, and that included a lot of loans that had a lot of lower credit borrowers behind it. And as a result, there was actually in 2008, part of what hurt the economy and hurt the mortgage market as a whole was the fact that some of these subprime loans that were backing those types of securities blew up. So it was really a borrower credit problem, borrower default problem. As home prices turned, people suddenly found that their homes were worth less than they owed. And on top of that, the Fed was raising rates on mortgages that were adjustable to short rates. So as those rose, it actually created tremendous stress in the housing market and the economy and for borrowers individually. This time, most of the mortgage market is, as I said, in very low coupons. It's fixed rate. The borrowers in general, because unemployment is very low, are still in very good shape. They're having, very little problem, most of them making their mortgage payments. And because it's fixed, they haven't been quite as affected, the people who own those loans,
right.
By the Fed raising rates. In contrast, though, anybody trying to take out mortgages now are seeing a much higher rate. And at the same time, when you alluded to the bank crisis, what's happened is these very low coupon mortgages now have a very low dollar price.
Right.
And so it's more of an interest rate sensitivity or duration, as we call it, problem than a credit problem right now. So that's a very key difference between then and now. Right.
So I'd like to move to a different indicator that I thought was exceptionally interesting that you published on your Bloomberg. You wrote a bit about the decline in the home mortgage origination that began sliding in January of 22. But you noted that a subset of the new home mortgage origination has recovered and quite quickly since the first quarter of 23. So what do you see in that trend?
Yeah, so what we're seeing actually is that because so many people are locked into these low coupon mortgages, they're not necessarily willing to put their houses on the market. And so existing home inventories are very low in terms of what's available for sale. However, the new home market is really growing. And they're able to do that in various different ways. They still have a lot of margin that they're willing to cut into to make sales. Because of supply constraints, it's actually taken a long time for some of these homes to come to market. So all of a sudden, home builders are finding themselves with a surplus of homes. And they also have discretion on how they can sell these homes. They can cut the prices a little bit, still have profit. They can even buy down people's mortgage rates, which they've been doing. So you might be able to get a 4% mortgage rate, at least for a couple of years. And after that, I think people are hoping the rates will have fallen and you might be able to refinance. So they're making it more affordable for new homeowners to conceivably buy their homes. On the other hand, they don't exist in all geographies. They only exist where there's room and space and incentive to build a home, and they certainly don't exist in all price points.
Right.
And they're generally more expensive because that's where the profit margins are. So they're not going to suit all homeowners, but it is actually growing, and as a result, that's growing as a percentage of the new origination mortgage market.
Yeah, as a homeowner and resident here in Manhattan, I wonder how many more luxury apartments can be bought. They seem to be propping up all over the place.
Well, keep in mind that the foreign buyers are back in too,
Yes.
and a lot of those are just cash buyers.
Yeah, it's in my building. Yeah, it's quite eye-opening.
Yep.
So back to the sector for a second. Prepayments are another very important indicator in the sector, and they are, cyclical, right? Are. So how do you see this number evolving in the future, and are there any risks for it in it?
I mean, prepayments it's more seasonal, I would say. They're also cyclical,
Yep.
Longer term cycles, but they're seasonal. And so in the short run, we are coming into the spring home buying season.
Right.
And even though a lot of people do feel locked in to their current mortgage rates, some of them will have to or want to move during the spring. And that's just really dictated in part by the school season because, parents prefer to move when their children are out of school so they can move to a new school, at the end of the summer. So we are seeing a little bit of an uptick, but we are still so close to all-time lows, and the current prepayment rates are below what you normally have, in midwinter. So there's two things that's driving that. One is housing turnover, which is very low, as I mentioned. I mean, there's to some degree there's home price appreciation built up because there's been such great housing market for the past few years. So, that is giving people some incentive to trade up, but then they have to go from their 2.5% mortgage rate to a 6.5% mortgage rate, and that's just unaffordable for many.
Right.
It's obviously the payments, double or triple what it had been.
Right.
For the same size house, and if you wanted to upgrade into the current priced house, which is higher than it was then,
Right.
that's an even bigger impediment. So turnover is a problem, and then there's very little refinancing incentive right now.
Right.
Maybe somebody who took out a mortgage in November of last year might want to take advantage of a 50 basis point fall, but there's also, a lot of price friction in there, not to mention the fact that the loan level price adjustments that FHFA, which is who runs Fannie and Freddie Mac, basically, they increased fees for refinancings
Right.
in order to actually reduce fees a little bit for some of the new homeowner programs that they have, which is more in line with their core mission.
Right. With the FHA fees as well as your bank fees, it would probably have to, I don't know if 50 bips would get you there.
Not usually. I mean, that's usually considered marginal, and that's often if you have home price appreciation already built up,
Right.
and maybe it's worth it to you, to move for one reason or another. But it's from a rate term refinancing incentives, it's probably not enough motivation.
Right. It takes a lot more than that. So the other thing that a lot of people have been writing and talking about is how the bank stresses might play out on the sector. So there are a couple likely outcomes from this. One is just more regulation. One is actually, sort of direct kind of credit hit. So how do you anticipate this will work out?
I do think there's going to be some credit crunch involved with this. That's the term a lot of people use. Which obviously play in that's, there's two different types of credit, right? We can talk about borrower credit like we had in 2008. That's fine. But we can talk about the willingness to lend.
Right.
And that's, I think, the type of credit. We're obviously talking about the credit availability. And that's already diminished, a lot, even from banks, but also from non-banks, because volatility has been so high that hedging costs and originating costs are very high. So that was already at the lowest level in I think since over 10 years, I think. But now it might even fall further, and it might permeate into other sectors, and that tends to slow down the economy. Now, we can argue that not that the Fed meant for banks to go under, but slowing down lending and slowing down borrowing is one of the ways in which they can slow down the economy, and perhaps hopefully with a soft landing, although that's not what our economics team is calling for. We're calling for at least a mild recession. But, at the very least, that helps control inflation. If borrowing gets more expensive, then people can spend less, companies can spend less, and it tends to help inflation deflate. So it's more a feature than a bug for the Fed for credit to get a little bit tighter here.
Right. And what do you think that means for MBS in the sort of near to midterm?
In the short term, there's a positive. One of the positives is that there's a lot less supply that probably comes into the market.
Okay.
So there's less for investors to have to absorb. In the longer run, it probably also makes banks, banks generally are going to be much less of a good buyer of mortgage-backed securities because the same things that are, encouraging them to tighten credit are also making them more risk-averse generally.
Right.
So, that keeps spreads a little bit wider. So there's a little bit of a give and take there in terms of how it affects the sector.
Okay. Are there other risks that you're following that we haven't covered so far?
I mean, going back to the prepayment risk a little bit. So I mentioned that prepayments, they slow down and they speed up in the spring, and they are slower than usual. Now, I would like to put that in the context of the current market, which is at an average dollar price of around 90 as we speak. And, for anybody who's not completely familiar with prepayments and doesn't live and breathe them, if you buy a security at 90 or even hold a security at 90, you're actually hoping that prepayments come in faster.
Right.
Because people return those principal payments at par, you can reinvest it at a higher level.
Right.
The sooner you get your money back, the better. So the more of a drag prepayments are on the sector, the lower the prices will be because, whether it's whether you want to call it extension risk or lack of carry, either way, slow prepayments in this case, which is unusual because normally in a 40-year bear market, the mortgage market has been on the whole at a premium or above par. Currently, the mortgage market is priced well below par.
Right.
So that's what makes negative convexity. That's why we get spread on mortgages. But it also means that very slow prepayments and maybe even slowing prepayments from here as credit tightens is not a positive. That's a headwind for the sector.
Okay, great. So if any of you are interested in reading a little bit further from Erica, check out your Bloomberg. She's on there a lot. Thank you for being here.
Thank you for having me. That was fun.